And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the Monday edition of The Real Investment Show. Yes, we're back from spring break. Glad to be here. And it's really interesting because we were gone for a week and nothing changed at all. I mean, I was expecting to come back and have lots of stuff to talk about, and yet nothing happened last week. We'll talk about that when we get into what you need to know before the bell this morning. But really, outside of just some very bland economic data, we did see some inflation numbers. They ticked up just a little bit. Not surprising. In November, December, January, February, there's a lot of anomalies that go on. Insurance values reset, those type of things. So we did see it, inflation pick up a little bit. It will work itself out as we get over the next few months. Again, we're also working on mathematical comparisons on a year-over-year basis. That's also kind of feeding into the number a bit. But, a little bit of angst last week about hotter than expected inflation. That's going to keep the Federal Reserve likely on the sidelines from cutting rates. And again, something we've talked about for a while is that really there's no reason for the Fed to cut rates. The Fed should keep rates where they are for longer. But again, the markets keep hoping for these rate cuts. And what's interesting now is that the markets have now realigned themselves with the Federal Reserve. So each quarter, the Federal Reserve comes out with what's called their infamous dot plot, which is all of the expectations on interest rates, inflation, unemployment from the Fed members. They put all their different things on a plot, and that's the dot plot. And that's really what the market's been kind of banking off of, is saying, okay, well, their dot plot says they're going to cut rates 3 times this year, as we get towards the end of the year. And of course, the market was expecting a whole lot more than that. Those have now realigned. Now, the big issue is that in the upcoming Fed meeting, the question is whether or not we'll see an uptick in that dot plot. In other words, kind of maybe cutting back rate cut expectations for this year, given that inflation has been a bit more sticky than what the Fed has previously anticipated. So will they raise that dot plot? Well, that could be the case, and the market's already kind of maybe suggesting that could be the issue as well. Expectations, we look at Fed funds future. Again, those have realigned with what the Fed was saying previously for 3 rate cuts. But we'll keep a watch on as we get closer to the meeting. If the market starts expecting the shift in the dot plot, we may see the Fed come out and say, okay, it's going to be higher for longer, maybe no rate cuts this year. Something I've said over the last few weeks is that there's a real possibility we don't get any rate cuts this year. May not be till next year. The risk, and something we'll talk about this morning, the risk of a recession is not off the table. It's just a function of all this liquidity that we have in the system. It's just taking a very long time to work that through the system. So that's delaying the onset of recessionary pressure, which could be into 2025. So again, we'll kind of go through some of that data this morning as well on the show. Outside of that, though, really it was a very quiet week last week. Earnings are mostly done. There's not a lot. There's just a few companies really kind of lagging here to report earnings. But the other side of this coin is that starting Friday, the blackout window for share buybacks has now started. So corporate share buybacks are stopped now for the next couple of weeks until we start earnings season again for the first quarter of 2024. So we'll start looking at first quarter earnings. Lots of expectations, though, for very good earnings season again. We had cut earnings going into Q4. So as we get into the Q1 era, we're back to expectations for a lot of beats, etc. So that's coming up here shortly. But that blackout window won't end until we get a couple of weeks into the actual new earnings season. So again, there's going to be a period here where one of the primary buyers, and this is actually an article I've got coming out tomorrow, I've got lots of data on this, but the buybacks have been a very important driver of this market since November. If you remember back in October when we were in the midst of that 10% decline over the summer, we talked about 3 reasons why we would get a rally at least into the end of the year. One of those was the extremely negative sentiment of investors. Investors were very bearish. Markets were deviated to the downside. We were very, very oversold, deviated from moving average to the downside. And corporate buybacks were about to start back up in November. And those were our 3 reasons for that rally into the end of the year. Of course, that's what happened. Now we have just the opposite, right? So we've had tremendous number of buybacks pushing, these share prices higher. Sentiment is extremely bullish with positioning extremely stretched to the upside. Professional investors are now leveraged long. They're now at 104% equity as of last week. And of course, you've also got markets that are very deviated from long-term means. So you have exactly the opposite setup that we had in October today. So that's going to be that's the interesting thing as we head forward. So here's what you need to know before the bell, though, this morning, is that, again, nothing happened last week. We were gone for the entire week. Nothing changed. Market sold off just a little bit on Wednesday, Thursday, Friday after reaching to the top of the trend line. Again, this kind of ongoing trend we've had, very stable. It's been a very stable, quiet, bullish trend. Not a lot of volatility. Just kind of trending higher right above that 20-day moving average, but just very well locked into this range of trading. We get to the top of the trend line, we sell off to the 20-day moving average, rally back to the top of the trend line, Wednesday, Thursday, Friday, sold off to the 20-day moving average this morning, futures pointing higher. The NASDAQ is expected to open up 147 points this morning. S&P is up about 20. So again, we're gonna see the Mag 7 stocks, really kind of driving the cart, so to speak. Google's going to be up 2.5% this morning on news that Apple is going to use Gemini for their AI on Apple phones, which I'm not sure if that's a great idea considering all the problems that Gemini had just recently, of course, with their historical representations of characters. But, I guess they'll get that problem solved, I guess, before Apple takes it on. But again, a licensing agreement between Apple and Google for the Gemini AI software is going to lift Google up this morning about 2.5%. And that's, kind of, the issue is that these main stocks, and again, we've seen this for most of this rally, has been driven by these very large cap stocks. And again, that's just where money's hiding. They're highly liquid. And again, we have this very complacent market. And again, as a professional manager, this is where they're saying, okay, where can I have access, where can I put capital where I can have easy access in and easy access out? In other words, I can move millions and millions of dollars in and out of a stock without moving the price a whole lot. Well, that's companies like Apple, Nvidia, Microsoft, very liquid, very safe. You're not going to wake up, if you're a professional manager managing hundreds of millions or billions of dollars for an institution, you don't want to wake up one morning and have a stock down 20 or 30%. That's not going to happen with an Apple or a Google in that case. So again, those are very safe places to put money, highly liquid, in and out is easy. And again, you kind of get those overall flows of their market capitalization weight. As money goes into index fund, it pushes those stocks higher. So it's been a very safe place for professional investors to hide capital. And that's one of the big drivers for this market this year, is just trying to get capital allocated to the markets as the markets continue this kind of rise higher. And again, we've just had a very, very long advance. We're very deviated from the long-term means. We keep kind of coming back to this. These deviations are fairly deep. The good news, though, is that we are finally breaking down out of that kind of overbought area. So Wednesday, Thursday, Friday, market sold off. We are starting to reduce some of that overbought condition. We're going to reverse that back up a little bit today. We are on a MACD sell signal, but that's been one that's been very tight here. The market's been very extended at this point. This low volatility advance has kept markets overbought. These signals are pretty much neutral at this moment. They're not really giving you a good signal in one direction or the other. And again, the signal that you're looking for here to reduce equity risk is going to be a break of this 20-day moving average. When that occurs, that's going to flip a lot of these algos that are consistently buying that 20-day moving average. Those will break and they'll start selling that break of the 20-day moving average. And that's where you're going to get this bigger correction. Again, when that comes and when it shows up, who knows? Could be a week, it could be a month, it could be this summer. We're going to get a correction, but it's just going to be a function of time until we get there. So anyway, just be careful, manage your risk accordingly, as always, and we'll keep you updated. But that's what you need to know before the bell this morning. But when we come back, we'll talk a little bit about a recessionary indicator that a lot of people don't pay attention to. So we'll get into that when we come back after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at Savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I'm convinced that my coffee maker is listening to us. You know, you talk about your phones listening to you. Well, I'm pretty convinced our coffee maker is doing that. So we have this Cuisinart coffee maker at home, and it's a very valuable member to our family. So, but it's terrible. It's a terrible product. It leaks. It just, you know, it does what it's supposed to. It makes coffee, right? But it leaks water. It's just not a great product. But that's what I get for not reading reviews on things before you buy something. I'm terrible about that. You know, I just when I need something for the house, right? Whatever, the coffee maker or whatever it is, I'll just find what I want. I order it, and I don't spend a lot of time researching reviews and all that. But here's a case where I should have read the reviews on this particular coffee maker. But I'll give you the backstory first, and then I'll get to why I should have read the reviews. So, you know, on Sunday night, we always set the coffee maker up so that in the morning, because, you know, my alarm goes off at 3:15. Set the coffee maker so that, you know, you wake up, the coffee's made, and you're ready to kind of get your day started. So we set it up at night so it's all ready to go. Set the timer so that it goes off at, you know, 3:30 in the morning, starts making the coffee while I'm taking a shower. So we're sitting there and we're watching a show on television. I've got my wife involved in watching the Jack Ryan series on Amazon. Very, very good if you haven't seen it. And so we start hearing the coffee maker starts making coffee. Okay. Well, so maybe the timer was messed up, right? Maybe there's a power outage or something and it reset the timer. So I'll go walk in the kitchen. The coffee maker's turned off. It's not turned on, and it's making coffee. And so it makes a full pot of coffee. And I tried to turn the coffee maker on and off, you know, the whole 9 yards. So I just went ahead and let it just make coffee. And And so we have this full pot of coffee sitting there. I'm like, no big deal. We'll just, leave it sit there. I'll heat it up in the morning, and that's what we'll use. And so that's all fine and dandy. So my wife says, this is enough. I'm tired of this coffee maker. So she goes online and she starts looking at coffee makers. Well, she starts by reading the reviews on the Cuisinart. And there's all these reviews that say this coffee maker's terrible. It leaks. It just does strange things all on its own, which is the things we've been experiencing. And then she was starting to read these to me. And she goes, one of the things that it does is that it will start smoking and just kind of create an electrical fire. And as she's reading this to me, we start hearing popping in the kitchen. Now remind you, the thing's turned off, right? We start hearing these popping noises in the kitchen. I walk in there, and sure as shoot, this thing is bellowed in smoke. And so I grab it, I run outside, and I just throw it out by the trash can, because the day was trash day anyway. So I just throw it out by the trash can. The thing's smoking. But anyway, so we are now minus a coffee maker this morning. But I still have my coffee from last night, so we're good to go. It's just cold, but it's good to go. But anyway, so that's my adventure with coffee makers. So I'm now on the search for a new coffee maker, and I will read the reviews this time to make sure. But I'm just sitting there wondering, oh man, just thank goodness it happened last night. I mean, if that would have happened during the day while we were all at work, no telling what would have happened. Anyway, so a couple of things that are going on. One of the things that we've talked about a good bit is recessionary indicators, right? So the leading economic index, it's been negative for the 6-month average rate of change has been negative for months and months and months now. It is the longest stretch on record ever for the leading economic indicators to be negative and not have a recession. The yield curve, the 10-year versus 2-year yield curve, has been negative, inverted, for quite a long time now. A very, very long stretch. Not the longest on record. That was back in the 70s. But still a very long stretch for the yield curve to be inverted, yet no recession. Now, just mind you, and I have a chart of this, which is this is the 10-year, 2-year yield curve, and you can see that it's negative. Now, importantly, the yield curve is negative. That's not your recessionary indicator. It's when it uninverts. As you'll notice that the recessions occur when the yield curve actually uninverts. That's when the recession starts. So we're not there yet. But as a indicator, it does suggest that a recession is coming, because eventually this yield curve will uninvert, and theoretically, if we have this uninversion of the yield curve, we should have a recession onset. But yeah, we haven't had a recession. So a lot of people are suggesting this time is different, and there's some reasons to do that, right? We've talked about the fiscal deficit spending. We've talked about, all the different programs, the Inflation Reduction Act, all these things that are the CHIPS Act, that's feeding money into the economy and keeping the economy kind of chugging along here, although it's kind of only in the headline numbers and not with the vast majority of Americans who are really struggling to make ends meet right now. But nonetheless, we haven't had an official recession yet, despite these indicators. And, as I was working through data, recently, and again, as we've talked about this massive amount of monetary supply, the M2, right? So M2 is the money that is actually working its way through the economy. That as a percentage of GDP is extremely high levels, and it is declining, and GDP is slowing. But GDP was so advanced from all that stimulus money, it's just taking a long time for that growth rate to revert. It'll eventually revert, and it'll eventually go negative. But again, this is one of the things that everybody's like, oh, we're going to have a recession this year, and it's like, no, this is going to take some time. And we've written articles about the pig and the python. It's just going to take a long time for that pig to move its way through the python. It may be 25. It could even be 26 at this point. But we'll see. But that money is coming out of the system. And as that money comes out of the system, we are slowing. The debt is going to continue to drag on economic prosperity. And the more debt that we keep leveraging on, the slower that economic prosperity will be. But the importance of an indicator is talking about employment, right? So employment as a measure is very important, because that is what drives. You can bring that chart back up, Brent. Because in order to have in order to have consumption, so the economy is 70% consumption. But in order to consume, and we've talked about this before on the show, you have to have a job first, right? You've got to go produce something to get paid, and then you can go buy stuff, right? You can't just go buy stuff willy-nilly unless the government's sending you money. And that was the problem that created inflation back during 2020, is the government sent money directly to people, and they could go buy stuff without producing first. And that created that demand imbalance that led to inflation. But individuals must produce, then they can go consume. As they consume, that creates demand. As they create demand, that creates more jobs. The more jobs gives people more money to spend, which they go spend that money, which creates more demand, and you have this virtuous cycle of economic activity. And that's where you have economic expansion. But the problem is right now is that we have a reversal of some of that. And one of the indicators that we're looking at in particular is full-time employment. So, Brent, you have to kind of work with me on this. I didn't embed this image. So, but one of the things is there's kind of two ways to look at full-time employment. So full-time employment is very important because that's what gives you the paycheck, higher wages, benefits for healthcare, insurance, those type of things. All the things that go on with a full-time job you don't get with part-time jobs. Whenever the year-over-year rate of change of full-time employment goes negative, which it just did, you typically have a recession in the economy. And that makes complete sense, right? Because if I am, not working at a full-time job, if I'm working part-time, my consumption's going to decline. And we've seen that the recent employment reports, despite the fact there being very strong employment reports, it's a lot of part-time work. It's a lot of foreign-born workers versus native-born workers, and that all leads to lower wage growth. Okay, and so if we take a look at that, kind of in a little bit different look, and we look at full-time employment relative to the working age population, and say, okay, well, how many people in the working age population are full-time employed? We just saw in the last couple of employment reports, last three, a very, very sharp decline in that full-time employment relative to the population. So that's sending a message, and we'll talk about what that message is when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at Savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors Classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Food in total is now making up 30% of the average discretionary income.
I believe it. I mean, that is our largest expense is food.
Yeah.
And we rarely eat out.
The Real Investment Show podcast.
Our biggest frustration at home is how do we do this cheaper?
Yeah. No, I agree. I agree. We're running Hunger Games at our house.
At realinvestmentadvice.com.
So, if you can make it to the table without getting killed, you get to eat.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. We're talking about a little bit of a different recession indicator, which is full-time employment. Doesn't get a lot of talk, kind of in the mainstream media about it, because the way we look at full-time employment, we just kind of throw that in with the numbers, and we just look at the unemployment rate and we say, oh, great, the unemployment rate's 3.9%. But at the same time, we've talked about cost and expenses and those type of things. Of course, Tyson right now under a huge amount of fire. They are closing one of their plants in Iowa, laying off 1,200 native-born workers, and they're seeking to hire 52,000 immigrants into their plants across the country, providing them, free immigration lawyers, support with housing, childcare, et cetera. And there's a lot of people are upset about that because there's a lot of native-born workers here in America right now that would love to have $16.50 an hour in wages and help with childcare and help with housing, those type of things. And yet we're doing that to help foreign-born workers that are waiting to try to get the legal status to work here. And that's why they're getting the immigration attorneys. So when we take a look at full-time employment, though, as a function, we don't really look at what that means for the overall economy. And again, as we talked about before, there's some very important things that go on with full-time employment. Can you bring that one chart back up? Full-time employment, thank you. So this is full-time employment relative to the working age population, which that population includes immigration. So as we are looking at this, there's a couple of things to note. It was interesting during the State of the Union address, President Biden was touting his very strong employment growth. He's created, more jobs than any other president in history, yada, yada, yada. That's not really the case because as we can see, the full-time employment relative to the population didn't even get back to where we were pre-pandemic under the Trump administration. And since then, we've now turned lower. So full-time employment is declining rather sharply this year. In fact, whenever you have sharp drop-offs in full-time employment, that's typically been coincident with recessionary onsets. Because, again, why? If I'm losing my full-time job, right, I'm probably not going to be spending as much in the economy. And if I'm not spending as much in the economy, well, that's less demand for businesses. They start cutting back, right? So this is why we're seeing a couple of things going on. So why is Tyson, getting rid of native-born workers to hire immigrants? Even with the other stuff they're doing for them, that's still a cheaper form of labor. They're trying to cut costs. And we're already seeing this in wage growth around the country, is that wage growth for non-supervisory employees. Now, these are non-supervisors. So this is the 80% of employees that are not executive supervisors, those type of things for businesses. These are your salaried workers. That wage growth has been declining rather sharply over the last 2 years. Now, why is that occurring? And why is Tyson, taking some of the actions they're taking? Well, it's because their CEOs are acting to protect profitability. And if I can do it cheaper, if I can get the labor done, these are labor-intensive jobs, right? This is blue-collar work for Tyson factories. And they're looking for ways to cut those costs. And again, this is exactly what you would expect. When there is a need to protect profitability, that's where you get a loss of employment. That leads to a loss of confidence for consumers. That leads to reduced consumption. Corporate revenues potentially decline. Then CEOs take further actions to protect profitability by reducing employment even more. And now you have this cycle that leads to recession. That's why full-time employment's a very important recessionary indicator. But we can also take a look at temporary services. That's also experiencing a decline in employment. And this is temporary help. So again, something that this is declines in temporary services is not something you see during an expansion. And you don't see that in concert with a decline in full-time employment. What you should be seeing is like, okay, great. Temporary services are declining because people are now getting full-time jobs, so I don't need the temporary work, right? That's not what's happening. You're seeing a decline on both sides. And if you take a look at the New York Fed survey of consumer expectations, the probability of finding a job in 3 months, if you lose your job today, will you be able to find a job in 3 months? That answer is becoming sharply no. These are not the indications of a strong, booming economic environment. And if I don't have a strong, booming economic environment where I'm getting a lot of demand from businesses, or from consumers, then businesses are going to take action. Now, remember, small businesses make up 50% of your employment in the country, right? This is your mom and pop retail stores, your gas stations, those type of things. And so if they're not expecting higher sales, right? If they're not looking forward, say, man, demand is really picking up, so I'm going to have to hire more people because I have all this demand. Now, remember, businesses are going to stretch their employment as far as they can. So, if I've got employees, I'm going to, and I've got demand that's increasing, I'm going to work those employees to the bone before I hire somebody else, because hiring somebody is very expensive. Hiring, training, all that type of stuff. So, and I want to make sure it's not just I'm having a little flash in the pan demand boom that's going to go away, and then I've hired all these people and then I'm stuck with them and demand slows back down again. So sales were improving post-pandemic, and they started hiring people. And now the question is are you planning on raising worker compensation? Are you planning on raising wages? More and more small businesses, and there's a rapid drop in it, are saying no, because the sales aren't there. Their expected sales are still at recessionary levels. Again, if I don't have strong, booming economic growth in sales, right, I'm not going to hire a bunch of people. I'm not going to raise their wages. So unsurprisingly, we're seeing a very sharp drop in that. Now, these are all things that suggest the economy is actually a whole lot weaker than what the headlines suggest. Now, again, this doesn't mean, and this is where we've got to be careful about this, it doesn't mean that you're going to have a recession next week, right? So don't run out and go, Lance said there's going to be a recession, so I'm selling everything going to cash. Don't do that. All I'm saying is that this is another one of those indicators that are working in the system right now that suggest that the economy is actually a whole lot weaker below the surface than what headlines suggest. Doesn't mean, though, that we're going to have a recession tomorrow because, again, there's so much liquidity in the system right now, that chart of M2 I showed you. There's so much money floating around the system. That money's got to come out of the system, and it's going to take time. And so we may be stuck with these kind of very recessionary indicators for quite some time before we actually get to a point to where we actually start seeing the implicit signs of an economic recession. And at that point, the Fed should be cutting rates rather dramatically to try to offset that recession. Interest rates should be dropping. All the things that go along with that. Inflation will be falling rather sharply as that demand dries. But we're seeing those. We're seeing that data, right? We're seeing that demand drop off in the system. And again, if you just kind of look around, just lately, if we go to restaurants that are normally packed, they're not quite so packed anymore. I mean, we're seeing people cutting back a lot. We just haven't seen it show up in the data yet, and have a feeling that it's coming, but it's just going to take a lot longer to get there because, again, there's so much money floating around the system. And again, the stock market's booming, right? That boosts confidence. That gets people to spend money because they feel good about their financial situation. And right now, they feel good about their financial situation. If you take a look at the recent Consumer Sentiment Index, the expectations of plenty of retirement income is near all-time highs. So from a stock market perspective, you got money invested in the markets, everything's fine for the moment. But everything's fine until you lose your full-time job. That's where it becomes problematic. And again, this is very early in the cycle, but we are seeing that impact of full-time employment. And so we'll keep a watch on that indicator to see if, over these next few employment reports, if that begins to improve, if we start seeing full-time employment improve or not. We'll see. But again, this is just one of those indicators that suggests there's more stress on the overall economy. Again, I'm really kind of preaching to the choir because people really aren't buying this idea that the economy is just kind of booming on all cylinders. Everybody's kind of looking at this economic data going, yeah, I see the data, but let me just tell you about my personal situation, right? And, that's just kind of this break between kind of the economic rhetoric and real life. And again, this isn't the first time we've seen this. I remember back in 2007, Bill Dudley was talking about, iPad, they were talking about inflation. Inflation was going up. And Bill Dudley of the Fed, he says, iPads are cheaper than they were. And one of the news reporters said, well, yeah, but you can't eat an iPad, right? But food and gas, that's really expensive. And that time, oil prices were surging. It was peak oil, all that type of thing. And again, we've seen these before. And remember, in 2007, even in early 2008, it was a Goldilocks economy. Everything was fine. There was no sign of a recession until there was. Now, I'm not saying there's a financial crisis coming, so don't go spread that rumor. I'm just saying nobody ever sees a recession coming until it's too late. All right, quick break. Come back. You're ready to wrap up the show. Don't go away.
Daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show, of course. Getting ready to kind of wrap things up this morning. Futures still pointing higher. Dow futures have now actually turned around. Dow futures were negative this morning. They've now turned positive. They're up about 60 points right now. S&P, NASDAQ still pointing higher as well. So again, as I was saying earlier this morning, this has been a very predictable market. Really, ever since November, market sells off to the 20-day moving average. You buy that dip. When the market hits the top of its running trend line, which isn't much, it gives you about a percent higher in the market, a percent or two higher. You get to the top of that index or that trend, and then it sells back off to the bottom. And it's been a kind of just a gradual staircase higher, right? And this is kind of interesting because it is very much that kind of escalator ride higher. It's just been a very smooth advance, not a lot of volatility. Volatility is very low here. But it's been that very much that escalator ride. That's an old Wall Street axiom that markets take the escalator up and the elevator down. In other words, you have when markets do break, and they will break, they tend to break rather sharply. So it's not that smooth ride up on the way down as well, right? You tend to get a rather sharp sell-off that occurs because when something changes, and again, what causes that? What is the event or the news or whatever it is that causes the change in sentiment? Everybody tends to sell at once, and that creates that selling pressure, right? So you get a very sharp move lower. And again, that's just how markets work. As we've talked about before, for every buyer, there has to be a seller. And it's been interesting because during this whole advance higher, institutions have been selling, Wall Street has been selling tech stocks along the way. But because somebody has to sell, right? So if retail is buying all of these real speculative names like SCMI and Bitcoin ETFs and all that, somebody's got to be selling something, right? You just can't magically create stuff out of thin air and then have somebody buy it. So somebody's selling. And so for the last 12 weeks, while the market's been moving higher, institutions have been actually underneath selling long positions. So are they wrong? Right? And they certainly seem to be wrong right now, and institutions always seem to be wrong. But Wall Street is kind of notorious for selling and shorting when markets are going higher. Again, because somebody has to sell something in order for you to buy it. So the question is who's wrong? And right now, it certainly seems, there certainly seems like you can do no wrong in this market. You buy anything, it just seems to go up. And it's interesting because if I look at my comments page on Twitter or Facebook, whatever it is, you see those same comments that you see at this stage of every bull run, which is, oh, this market's, this is the can't stop, won't stop bull market. It's going to go up permanently. That's, this time is different for A, B, or C reasons. It's so easy. I just throw money into the markets and I make money. I'm going to quit my day job and, all that. That's the same type of attitude that you see a good bit of. And I'm seeing a lot of those comments right now, which are normally that's a really good contrarian indicator. But again, as with all things, it doesn't mean that the markets are going to correct today. Right? And this is the hard part about managing money is that, you have to ride the bike, as long as you can. And at some point, the market is going to correct. At some point, you're going to break and the market's going to go lower for whatever period of time. And again, we're not talking, let's not all panic here. We're not talking about the next great financial crisis. We're talking about a 5 to 10% correction. Absolutely normal, healthy. And you need it, right? You need to have a correction in the markets for markets to be healthy. And so that you work off these overbought conditions, you work off these stretches, these deviations from longer-term moving averages, and then you can have the next move higher. So you need these healthy kind of 5 to 10% corrections in a given year, and that'll give you a much better opportunity to put more capital to work. So again, if you've got capital to put to work, maybe just kind of hang on to it for right now. There's no sense in really overpaying for asset prices that are grossly extended that are likely to be the ones that have the biggest corrections. So just, it's just one of those periods. And we'll see how this works out and what this means, for the markets. But, I was just talking about on Friday, and we'll talk about this article a little bit more tomorrow, but household allocations are now back to some of their highest levels on record, which historically is not a good sign. I mean, that's a very contrarian indicator. But it also, as household allocations to equities are increasing, obviously that's why you have a bull market. But it also suggests that forward returns are going to be a lot lower. Because again, it's just, for every buyer, there has to be a seller. And at some point, you kind of just run out of buyers. You just think about 2 rooms of people. In a healthy market, I've got the same numbers of buyers and sellers. In an unhealthy market, I've got all buyers and no sellers, right? And so that's just driving prices higher because I have very few people willing to sell. I got a bunch of people that want to buy. So it's a supply-demand imbalance. It is a market, right? And if you have the supply-demand imbalance between buyers and sellers, you're going to have these deviations in prices, these, issues with market extensions and momentum that lead to corrections at some point when that balance changes. And again, at some point, there'll be an event, there'll be a news story, there'll be whatever it is. The Fed comes out and says, hey, we're higher for longer. We're not going to cut rates this year. Whatever it is, all the buyers then go, oh, I'm selling. And then you have a big rush of buyers, previous buyers that now all want to be sellers, but yet there's no person over here wanting to buy anything because now everybody wants to sell. And that's how you have these corrections. And now what causes that, who knows? And I have no idea when it'll happen. But, this is the risk that we've got to be paying attention to. One other kind of news item that happened while we were on vacation is something we talked about previously. The National Association of Realtors got sued over rigging, particularly with a 6% commission, right? So if you've ever sold a home as the seller, when you sell your house, you pay a 6% commission. And 3% goes to the buyer's agent, 3% goes to the seller's agent. Everybody makes a ton of money, and that's why people like being real estate agents, because I manage money all year long for less than 1%, and they get 6% for selling a house and don't do a whole lot. So this was kind of an issue, and it was a lawsuit that was filed, and we talked about that lawsuit previously, and it was interesting because the National Association of Realtors has now settled that claim for $418 million in damages. And they're eliminating rules on the commissions. This was an article on CNN. The National Association of Realtors, which represents more than 1 million realtors, also agreed to put in a new set of rules. One prohibits agents' compensation from being included in listing places, on listings placed on local centralized listing portals known as multiple listing services. So that's the MLS system, multiple listing services. Another ends requirements that brokers subscribe to MLS services, right? So National Association of Realtors required their agents to be and subscribe to those MLS services. That's now gone. And most of those MLS services are owned by the National Association of Realtors. So this is the collusion part, right? This is part of that lawsuit. Because it was all kind of a bid rigging scheme by the NAR. So another new rule is going to require brokers to enter into written agreements with their buyers. So the in theory, and we'll see what happens now, people are generally very creative about figuring a way around rules. So CNN suggests that this agreement will effectively destroy the current home buying and selling business model in which sellers pay both their broker and buyer's broker, which critics have say driven up housing prices artificially. And again, that's kind of the case, right? Because if I've got to pay the commission, I need X for my house. So in order to get X for my house, I've got to boost the price to cover the commission, right? So that's the theory here. By some estimates, real estate commissions are expected to fall 25 to 50%, according to TD Cowen Insights, and this is going to open up alternatives. And what's going to be interesting is this does create a potential game changer for a lot of these kind of home buying, home selling apps that are out there that are willing to do things a whole lot cheaper. And by kind of breaking that business model that the NAR controlled, this may open up opportunities for a whole lot of the quote unquote disruption in the real estate market. And again, we could very well see that fees for selling a home drop markedly as competition is now allowed to set in. We'll see what happens. It's going to be very interesting, but this could change the whole real estate market to a great degree. A lot of people have made a ton of money being real estate agents and brokers, and you see all the shows on television with these real estate firms selling these multi-million-dollar homes, and it shows they make $250,000 commission on selling this house, right? This could change that whole game, and it opens up the ability now potentially for a whole new suite of technology to come in, and especially with artificial intelligence, right? To really dramatically lower that cost of selling real estate. That's what happened to the brokerage industry, the advisory industry. Advisors used to charge 2.5% or 3% to manage money. Now it's less than 1% because of competition, ETFs, those type of things, technology. It's going to be very interesting to watch. Okay, that wraps up the show for the day. Be back here tomorrow. We'll talk about equity allocations, and importantly, I've got a really important article coming out tomorrow about corporate share buybacks. We'll talk about that as well. We'll see you then.